This concept of buy the dip comes more from speculators. True investors that have been operating in these markets for years know there are certain times in the antiques and collectibles trade where a market gets ultra hot and it hits all-time price highs. That market, even if new collectors come into it, never ever gets to those prices again, because the new collectors that come in either aren't willing to pay that high of a price for these items, or they're interested in something else. Meaning, let's say certain vintage sports cards end up hitting a new high and younger collectors start coming into that market. Well, maybe they don't want to go after those same players. Now, there's always the concept of what we call blue chip collectibles, like a Mickey Mantle rookie card. Something like that is considered a blue chip, but there's no guarantee it's going to keep going up in value year after year. Again, it's the greater fool theory.
Was so like the sports card market is trending down, but the common narrative, this is been some time now, so this has kind of changed a little bit, but the common narrative is still that the sports card market will turn around in 1 to 3 years, and if you buy the dip now, you'll make a lot of money, and the outcome doesn't seem likely, but people still persist. And why do you think they're persisting?
Well, the people that say that buy the dip in the antiques and the collectibles trade, I'm going to be very honest with you, they tend to have a speculator mindset. They are not on the investor side of the trade, because you got to understand the antiques and collectibles trade, any market in the antiques and collectibles trade is pretty much speculative in its nature. It's almost like a bubble that contrasts and expands based on collector and investor demand. That's really all it is, because we can't attribute cash flows to any of these items because they all reside on the greater fool theory. I mean, let's be realistic. If you come to me and you say, Shawn, I want to invest in an S&P 500 index fund, I could sit down with you. I can tell you, these are the companies that make up the S&P 500 index fund. You can literally go through, you can pull their financials. You can see how much they have in cash flow, debt to equity ratios, PE ratios, inventory turnover ratios. If you wanted to, you could study all this stuff. There's numbers behind it that matter, because most of those companies, not all, but most of them pay a quarterly dividend. So if you owned an S&P 500 index fund, whether it's through Vanguard, T. Rowe Price, Fidelity, pick your poison, Charles Schwab, whatever company you want to deal with, you're going to get a dividend from that every 3 months that is based on the cash flow that those companies generate. Makes sense, right? With antiques and collectibles, there is no cash flow. It's simply consumer supply and demand occurring on the secondary market that is completely outside the actual collectors or investors' control. So what that means is, if I go to the market and I pay $20,000 for a comic book, there's no guarantee that that comic book is really worth $20,000. It's great that there's data out there that says somebody paid $20,000 for it, and I just paid $20,000 for it. But in reality, I could go consign that comic book that I just paid $20,000 for back to the auction house. They could put it in a sale, and it could go for $15,000, or it can go for $25,000. So what's the actual value of the comic book? Is it 15, 20, 25? And that's where these markets, a lot of people do not understand this. They're extremely speculative. It's my same problem with cryptocurrency. If you ever talk to me about cryptocurrency, I think it's the greatest scam ever created. I tell people that I do not like cryptocurrency for that reason. There's nothing behind it. It's just, oh, look at this. I'm scared of fiat currency. I'm going to put my money in this other speculative thing. And it's insane. You're trading one poison for another. Pick your poison. That's really what it is. There's nothing behind any of this. So when we look at these markets, we have to look at them from the standpoint that literally most will not go to zero, hopefully, unless if you're holding Beanie Babies or Pogs, or, I hate to say it, Funko Pops in certain instances. All those markets are pretty much related in the speculative territory. But if you're buying rare coins, you know, higher end vintage comic books, vintage sports cards, items that have been around the antiques and collectibles trade for some time that you know people are interested in, the items aren't going to go to zero, but it doesn't mean you're going to make a fortune off them. So this concept of buy the dip comes more from speculators. True investors that have been operating in these markets for years know there are certain times in the antiques and collectibles trade where a market gets ultra hot and it hits all-time price highs. That market, even if new collectors come into it, never ever gets to those prices again, because the new collectors that come in either aren't willing to pay that high of a price for these items, or they're interested in something else. Meaning, let's say certain vintage sports cards end up hitting a new high and younger collectors start coming into that market. Well, maybe they don't want to go after those same players. Now, there's always the concept of what we call blue chip collectibles, like a Mickey Mantle rookie card. Something like that is considered a blue chip, but there's no guarantee it's going to keep going up in value year after year. Again, it's the greater fool theory. I paid this for this item. For me to sell it into the market, make a profit, somebody has to pay more than me for that particular item. And it also has to cover my costs, meaning if I go to consign that to an auction, there's consignment fees, there's commission fees. It has to cover all those costs for me to be able to make a profit. And that's what people don't realize. So I do not like the concept of let's buy the dip. In certain collecting categories, it makes more sense than others. If you're going to invest in, let me give you some examples, coins, currency that are high end. If you're going to invest in historical documents, like you get a signed letter from George Washington, something of that caliber that has meaning. Certain pieces of high end art, firearms, edged weapons of a historical significance. If you're going to buy the dip in those markets, if we ever hit a depression, you have a better chance of, or I should say a recession, not really a depression, but we have a better chance of making money when the market rebounds than some of this crazy stuff like modern era sports cards, Pokemon cards, Lego, even certain vintage toys that are considered established, like vintage Star Wars, G.I. Joe, Transformers. That's all very risky.
Yeah, I'm starting to hear people say, I mean, for a time, video games, people were into video games, and then VHS tapes, a 3DS, a DS, people are building
3DS,
DS games.
yeah.
Oh, okay. And I heard cassette tapes recently. Like, so basically, they're just gonna put everything in plastic. If it's in plastic, they put a grade on it, and it's from like somewhere in the past. There's somebody out there that's gonna try to pay more money for it.
Unfortunately, yes, that's really where we're at right now.
Okay. All right. Wow. Okay. Um, I get so the next question I have is there's this thing where early on in the card market, people were more reserved. They were only looking at like basketball cards, football cards, maybe baseball, and that was pretty it. Anything else was more of a they saw it as extremely. I mean, stuff I just mentioned is risky, but they saw everything else extremely risky. And then so